Welcome, everyone, to a brand new explainer right here on the GAAP Advisors Ind AS Clinic YouTube channel. I'm absolutely thrilled to have you with us today. We're going to be breaking down some pretty complex accounting standards and turning them into crystal clear, actionable knowledge. So, let's jump right in, shall we? Now, before we get into the heavy technical weeds, let's talk about the retail reality for a second. You might be wondering, why should anyone investing their hard-earned money into the shares of listed companies actually care about accounting standards? Well, understanding these rules is absolutely crucial. Think of it like looking under the hood of a car. It's the only real way you can verify the true financial health and performance of the companies you're trusting with your money. Grasping these concepts gives you the power to see right past the surface numbers. Just to set our baseline for today's clinic real quick, keep a couple of foundational rules in mind. Our functional currency and presentation currency is the Indian rupee. Naturally, any currency other than the functional currency is considered foreign currency. And as always, our standard reporting period runs from the 1st of April right through to the 31st of March. Also, just a quick heads up on our standard disclaimer. The views expressed in this explainer are the personal views of the author, C.A. Manish C. Iyer, and they aren't binding on the audience. We always highly recommend that you seek the help of an expert before taking any action or, refraining from any action based on the stuff we're discussing today. All right, here is our clinical agenda for today. First, we'll look at the investor's bond dilemma. Then we'll run the two core tests, analyze the time value of money, deliver our final accounting verdict, and wrap things up by exploring some really fantastic GAAP resources.
Let's kick things off with Section 1, the investor's bond dilemma, examining the presenting symptoms of Company A.
So, imagine stepping into the waiting room. Our patient today, Company A, has a pretty massive diagnostic question on their hands. Can they classify their investment in a non-cumulative bond under fair value through other comprehensive income, or FVTOCI? This classification has huge implications for exactly how their balance sheet and income statements are going to look, so getting this diagnosis right is literally a game changer for them.
Here are the actual facts of the case. Company A invested in a fixed-rate bond. But here's the catch. The terms of this bond are strictly non-cumulative in nature. Now, despite that, Company A fully expects to receive regular interest. Why? Well, simply because of historical past trends. They've always gotten it before, so they just assume they're going to get it now. But we have to ask, does an expectation actually override a written contract?
Moving right along to Section 2, the two core tests. It's time to run the Ind AS 109 diagnostics.
To solve Company A's dilemma, we've got to head straight into the lab. Paragraph 4.12a of Ind AS 109 lays down two mandatory hurdles for FVTOCI classification. First up is the business model test, meaning the asset is held within a business model where the goal is achieved by both collecting contractual cash flows and selling the financial assets. Second is the Contractual Cash Flow Test, which we often just call the SPPI test. And remember, you have to pass both of these, no exceptions.
Now, what exactly is SPPI? It stands for Solely Payments of Principal and Interest. The Contractual Cash Flow Test demands that the contractual terms of your asset give rise, on specified dates, to cash flows that are solely payments of principal and interest on the principal amount outstanding. In plain English, the cash flows just need to be consistent with a basic lending arrangement. Nothing exotic, just your standard lending setup.
All right, Section 3, time value of money. Let's analyze those lab results. This is where it gets really fascinating. If you do a direct comparison between cumulative and non-cumulative bonds, a clear truth emerges. Non-cumulative bonds generally fail the SPPI test right out of the gate because they simply don't guarantee those specified cash flows. The only way they survive is if there's a redemption premium that specifically compensates for the time value of money. But get this, even cumulative bonds can fail. Why? Because accounting nomenclature, the fancy label you slap on a bond, doesn't actually dictate the proper accounting treatment.
The absolute golden rule here comes directly from paragraph B4.1.7a of Ind AS 109. It tells us that in a basic lending arrangement, consideration for the time value of money and credit risk are usually the most significant elements of interest. So for the cash flows to actually mimic a basic lending arrangement, the financial asset absolutely must provide consideration for the time value of money. And how exactly does it do that? By providing interest on unpaid interest.
And this brilliantly highlights the core of our diagnosis, simple interest versus compound interest. Think about it like this.
If a bond, even one explicitly labeled as a cumulative bond, only accumulates interest on a simple interest basis and does not compound, meaning no interest is paid on the unpaid interest, well, it completely fails to provide consideration for the time value of money. Therefore, it totally fails the contractual cash flow test. Make sense?
Which brings us to Section 4, the final accounting verdict. Time to deliver the prescription.
Okay, so here is our final verdict for Company A. Their non-cumulative bond totally fails the contractual cash flow test because it doesn't guarantee those specified payments. The only exception would be if a redemption premium fully compensated for that time value. Remember, just expecting regular interest because it happened in the past does not change the actual ink on the contract. And, as we just saw, even if they had a cumulative bond, it would still fail if it didn't compound interest. Ultimately, to unlock that FVOCI classification, you absolutely have to pass the whole shebang, both the business model and the SPPI tests.
Finally, Section 5, explore more GAAP resources. Let's handle discharge and follow-up.
You know, the complex issue we just unpacked was actually featured in the 236th edition of the GAAP Advisors Task Weekly newsletter, authored by CA Manish C. Iyer, Director at GAAP Advisors. Over 230 editions have been published on LinkedIn so far, so if you're on LinkedIn, definitely go subscribe for free. You can also find this exact issue, along with a massive repository of over 4,500 other resolved issues on Indian accounting standards and Indian GAAP, over at gapadvisors.com. Anyone can register for free, submit issues, and get detailed responses delivered straight to your inbox. It is incredibly useful, especially for auditors who need to document how they tackled Ind AS applications. And hey, if you need personalized advice, you can book a one-on-one consultation on Ind AS and IFRS with the author directly on his topmate.io page.
Thank you all so much for hanging out with me today. If you found this explainer helpful, please go ahead and smash that like button, drop a comment down below with your thoughts, and make sure to subscribe to the GAAP Advisors Ind AS Clinic channel if you aren't already. We'd also love it if you shared this explainer with your contacts, your colleagues, your audit and finance teams, and any students you know pursuing their CA course. It really helps spread the knowledge of Indian accounting standards. Oh, and definitely follow the GAAP Advisors Ind AS Clinic WhatsApp channel for instant updates on all our latest explainers, podcasts, newsletters, and new standards issued.
And one last thing, are you ready for more? Ask yourself, could the bonds sitting on your own company's balance sheet right now actually be misclassified? To find out for sure and to explore the deepest mechanics of this specific case study, I highly encourage you to go connect with the GAAP Advisors Ind AS Clinic podcast. It's available right now on Spotify, Amazon, or right here on YouTube for a complete deep dive. Keep learning, keep analyzing, and we will see you in the next explainer.